Hello and welcome to the Monday Futures Market Outlook for June 4th, 2012. This is Patrick Srezna. For those of you that have not had the opportunity to try out eminisource.com's trading room, complimentary memberships are available on the website. As always, we start off with a chart of the US dollar index futures, and we have now come within a hairline of our 84.85 upside target with the jobs number creating a reversal candle here. We are going to take a short-term neutral stance rather than remaining short-term bullish. We're going to remain long-term bullish to US dollar, as we don't believe that this will be a change in trend, but rather simply that the short-term targets have been met, and it's quite possible that we may at some juncture go into a more of a sideways consolidation at these higher levels. That US dollar can still on the short term still have bursts up towards 84.85, but again we're going to start going neutral largely because we don't feel that there's enough short-term profit potential left in order for us to remain with the bullish stance. Again, that does not mean that we are going to become bearish to US dollar, just simply identifying that the move on the upside at least is long in the tooth. Next year, I want to take a look at the Euro FX, and the Euro was able to actually reverse a little bit like the US dollar, but obviously from the downside. This, in our opinion, is not the end of this Euro trend as well. While there's room for a bounce, maybe even back to 126, 127 on the upside, we do believe that the Euro is likely still to finish its move on the downside. We've been targeting that 118 to even the 122 area on the upside. We came obviously within a hairline of that. While there is probably still 300-400 pips downside risk here, we again, just like with the US dollar, believe that this initial Euro move is getting long in the tooth, and that there's diminished profit potential on the downside. So we're gonna that's a part of the reason why we remain neutral. While we certainly do believe that the Euro still can weaken in the next little cycle here, we are still going to remain relatively neutral on the short term, but big picture still distinctly bearish the Euro. Next year, I want to take a look at the 30-year Treasury bond, and the Treasury bond, based on those job numbers, actually has now hit our upside target. Another reason why on the short term we're going to go neutral bonds as well. Really, at this stage, it's not so much that we're actually bearish. We're going to still remain long-term bullish bonds, but on the short term, we believe that the move is completed, and therefore there is room for that consolidation off of these highs, and there's only limited upside potential over the next month or two, and therefore we're going to go neutral on that. At some point when we get a good healthy consolidation, we will be looking for another buying opportunity in Treasury bonds. So we are not going to be aggressively shorting this, but we are looking for a pullback here in the upcoming month. Next year, I want to take a look at copper futures, and copper made a direct test of that 320, 325 level and is already coming off of that low. Again, we've starting to achieve some of the immediate downside targets, while there is room for another burst of copper down towards the 310 area on the downside. We again, on commodities as a whole, are going to a short-term neutral stance because of the downside targets being complete. So again, just like in the same theme as the other ones, it's not that we're going to be bullish copper. It's just simply that we feel that being short copper has only limited profit potential at this point, and before some sort of a bigger picture consolidation. So we are going to go to a neutral stance. There is room for copper to sell one more burst lower on the downside. But if you are still short copper, use any short-term weakness as probably an opportunity to finish locking in all your profits. Next year, we're going to take a look at crude oil. We can again see crude oil has sold substantially. We adjusted our focal points a little bit. Our first upper focal point lies where all those lows came in back in December and February. And really, at this stage, with oil being so extremely oversold on the downside, we think that again that there's only limited downside potential here before a bounce. So that's why we're going to that neutral stance on the short term. term, crude oil could very easily work its way back to the $88 to $92 area, and even if it has a robust enough move, it could even go back to 95, 97. I don't necessarily think that that's a reasonable target, but it could happen. But we certainly there is room for a $5 move on crude oil at some point on the upside once this oversold state gets really in motion. Next year, I want to take a look at gold futures, and gold actually had a very robust reversal on the upside based on that jobs number that came out that weakened the U.S. dollar. That this is right at a major support line, so it's interesting that it occurred that way. Really, at this stage, there is room for gold to make it all the way back to even 1650 at this point on the upside. And in the bigger picture, there might be a chance that gold may actually bang out a key low along these things. We've been looking for 1440 on the downside, but whenever you got a big reversal day like this, you want to see where what kind of follow through comes in on that. So we're sort of cautiously starting to be a little more neutral to a little slightly optimistic, but there's a lot more than a one-day reversal that has to happen for the bigger picture outlook for gold to change. That brings us to wanting to take a look at the stock market. We're going to take a look at the weekly chart of the S&P 500 going back 3 decades, and we plot that 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that the market has gone through. What's interesting is right now as we speak, the S&P is trading right at, if not slightly below, that 80-week moving average. This is sort of that line in the sand that has always divided bull and bear market cycles, and it'll be interesting to see what happens here. The market may at some point bounce and push above there, but anything that sustains price action below there may mean a prolonged recession or some form of a market consolidation. We don't necessarily believe that this has to become a bear market the way we saw in 2008 or 2000 to 2003, but it's certainly how they start. So we want to be very cautious and watching how the market reacts to these prices at these levels. When you take a look at that S&P on the daily charts, we've now been consolidating right along that 1275 to 1290 level. Briefly, in the Asian session over the weekend, we had a small spurt down towards 1260. We still believe even 1240 to 1260 are all reasonable downside targets. There is even moves that could go down to 1210 on the downside. But we do believe again that the S&P is now probably closer to the bottom than it is to the top, which means that at this point we're going to go to a little bit more of a neutral stance on the short term, as we have to be very cautious in profit taking into any further weakness on the shorts. Really at this stage, any quick burst down will probably be opportunities to lock some profits in on those short opportunities, and then we'll see where that short-term market bottom bangs out. We do believe that this is not going to be the buying opportunity of the year. This will represent simply a much needed market rally after a very oversold state of the market, and we do believe that at a later point this summer there is going to be still yet another wave of selling. So really at this point we're simply looking at a short-term bounce, and therefore we're just going to go to a neutral stance and not a bullish stance as we weaken in here. So that's where we are looking for a short-term bottom. Let's see how low that goes before banging out that low. So just to point out the key intermarket observations, you can see here that we are going short-term neutral on just about everything, simply because it's so extremely oversold that we wouldn't want to give the impression that we think that continuing to short commodities and stocks, or continuing to go long bonds and U.S. dollar on the very short term is prudent. Our longer-term stances are quite distinctly still the same, and there's no reason at this point for them to change. Stocks at some point we may be based on that 80-week moving average crossover. At some point we may switch to a bearish longer term forecast, but really at this stage it's we're going to probably see a period of even 3-4 weeks where the market has to absorb everything that sort of happened at these price levels, and that's where we can set up the next big wave of trading opportunities. That was your Monday Futures Market Outlook. Thank you for joining me.